when you have conversations with clients, especially early on in the relationship, it's not about the S&P or the Russell or the Nasdaq. What's your money doing for you today? What do you want it to do? And I think you have that conversation from day one, and that's how you frame everything you're doing, because ultimately I think that approach leads to much better client outcomes, because it leads to better client behavior.
Welcome, everybody. This is Josh Flade, your co-host. I'm also here with Paisley Nardini with Building Better Portfolios. And this is episode 8. And for those who don't know, there's a great statistic out there that most podcasts don't make it past 7 episodes. So we are super happy that we have made it to episode 8. And in fact, I'm really glad that we have Tim Holland here, the Chief Investment Officer at Orion Advisor Solutions, as our episode 8 guest to help us get past that episode 7 kind of barrier that a lot of podcasts end up failing at. So Tim, you and I know each other very well. You were a mentor of mine when I was at Orion, and a coworker, colleague, and just like a great human being that I learned a lot from. So I'm really glad that we can have you on this podcast.
No, it's good to see you, Josh. You are and were a mentor to me, and it's nice to meet Paisley, and congratulations on episode 8. And I see that you didn't have me on episode 7. You made sure you got past episode 7, and then you're like, okay, maybe we can have Tim Holland on. Let's not
take that as a compliment.
Yeah,
I don't.
You didn't want to waste
I guess. Yeah. Anyway, congratulations on building better portfolios. And I know it's not just about portfolios; it's about better lives. But that's awesome, because it's not easy to do. So good for you guys, and thanks for having me on. And Josh, it's always great to see you.
Yeah, no, it's awesome having you on it. And, this is the #1 podcast in the investment podcast universe, at least
I heard
that right now. So we'll get there. Yeah. Well, Tim, why don't you, for those who are listening who don't know you, do you mind just telling us a little bit about your role, about Orion Advisor Solutions, and a couple stats real quick, not to steal your thunder, but for those who don't know, and most people in this industry do know who Orion is. Orion Advisor Solutions is a fintech firm that also is a big asset manager. Most people don't know that, but on the fintech side, they see $5 trillion plus in assets flowing through their platform. That platform is a tech stack that allows financial advisors to do billing, to do trading, to do all these different things, financial planning. And then on the investment side, you have more than $100 billion in assets under management, which is just a tremendous amount of money. And so, and most people don't realize that you have this whole investment platform that is a fantastic investment platform. So with that said, Tim, let fill us in a little bit about you, fill us a little bit more about Orion. And then also, if you could share something about yourself that most people don't know, we'd love to hear that.
All right. So the way I think about Orion and talk about Orion is one of the few companies in our space that has just about anything an advisor needs if he or she wants to be independent, wants to hang out their own single. I mean, we work with some big partners for sure as well, but we're one of the few players in the advisor-facing community that has a tech stack and an investment solution set that can put an advisor into business today. Say they left a bulge bracket firm yesterday, he or she wanted to break away or start an RIA or go independent. There are a couple companies that have the technology and the investment solution set that could put them into business straight away. Orion is one of those. To your point on the tech side, financial planning software, compliance, risk analytics, and the like, and over $5 trillion in tech AUA. And then on the investment side, an investment platform that includes proprietary and third-party investment solutions, multi-asset, single ticker. We have a quantitative team. We have a fixed income team, as you know, Josh, which you used to lead when you were part of Orion, and obviously helped stand up Town Square, which was one of the acquisitions that Orion did. So between some really good, I think, organic growth, a pretty strong market, as we know, and some fantastic acquisitions, which includes Brinker Capital and Town Square, which has been rebranded Orion OCIO. We built, to your point, a $110 billion AUM investment platform that goes hand in glove with this tech stack that serves advisors that are responsible for 5 trillion in AUM. I live on the investment side as CIO, working with our team that's responsible for both proprietary solutions that we manage and deliver, but also responsible for the due diligence work that we do around this very expansive and I think well curated and thoughtfully constructed investment platform. So that's how I spend my days. In terms of something not many folks know, maybe not the most exciting data point, but in the early 90s, when I got out of school and I had a day job in Manhattan, but that wasn't paying the bills or the student loan payments either. I also pulled a tap at a bar in Hoboken for about 5 years, which was a lot of fun. So yes, I was a bartender way back when.
That's a skill that I think pays off for the rest of your life, right? Like it's like golfing, skiing, bartending, like that.
Well, we weren't really. So at the risk of going off the rails, it was a really neat spot. It was in the middle. Now Hoboken just exploded, right? And so this is 30 some odd years ago, and it was already sort of coming up because Manhattan had gotten expensive in the 80s, and you had these young professionals moving in. The bar was interesting in that it was a mix of sort of locals during the day and then sort of young professionals at night and some transient folks coming in from the suburbs. I don't know if you guys have worked with there, we're going to see this, but it is the number one financial services podcast, though, so they might. None of us were real bartenders. Like no
Rocking.
one. Yeah. Okay. Thank you, Paisley. And the policy was, if someone asked for a drink and you didn't know how to make it, which happened all the time, you would ask them what was in it, and if they didn't know how to make it, they were out of luck.
Then you got to make them whatever you wanted.
That's amazing.
Pretty much.
How about a beer?
Yeah. How about a beer and a shot? So I used to be, trust me, 35 years ago, I was really, so we were hired more just because we were all pretty big people and we could throw people out of the bar if we had to. And no one was, we were terrible bartenders, but the owner didn't seem to mind.
So less mixologist and more just big guys that could kick people out.
That was kind of it. I worked with some some of these, one guy was a master carpenter. The other guys were painters. These were, some tough guys. So I was kind of the runt of the litter. And when all heck broke loose, I just kind of hid behind them because they were some pretty intimidating North Jersey types from way back when. So, but it was a lot of fun.
That is awesome. Well, let's talk a little bit more about Orion, and I know that Orion, one of a handful of really great things about Orion's investment platform is the due diligence team led by Chris Hart, who I know Chris Hart really well and worked with him as well as working with you. I would love to hear a little bit more about kind of that due diligence team and how that plays into this idea of building better portfolios, because as I think about building better portfolios, and Paisley would agree, I mean, due diligence is a key component, I think, to building better portfolios. So do you mind just kind of filling us in on the due diligence team, what they do, what are some key things that they're looking at?
So Chris Hart runs due diligence for us. Like myself, Chris is a Brinker Capital veteran, and Brinker Capital was acquired, came under the Orion umbrella about 5 years ago. Chris has got north of 25 years of due diligence experience, senior due diligence roles at Morgan Stanley before coming to Brinker probably 10 years ago. And he has a 8-person team. Chris and I share a wall here in our building in the Philadelphia suburbs in Berwyn, Pennsylvania. So Chris is one of the most experienced, most thoughtful, most competent due diligence professionals I've ever come across. His team's fantastic. Everyone on the team that reports up to Chris holds the CFA charter. I know you are both very active in that community. The one person who doesn't is pursuing it, so we've got our fingers crossed for him because it's obviously hard to get to. But Chris and his team are responsible for all third-party product that lives on the platform, multi-asset class models and single ticker solutions. They publish guiding star reports, which is a look at 5 key factors, including philosophy and people around investment strategies. The DDQs, the due diligence questionnaires, are going out. They're doing the annual on-site visits. They're writing up and refreshing those research reports. They're sharing them with our sales team that can share them with the advisors who are interested in a particular strategy on the platform. And they've also set up a select list and a watch list to help our advisors, sort of navigate what's become a pretty broad and pretty comprehensive solution set from a third-party product point of view. And the watch list is, as you might expect, some strategies that we're paying particularly close attention to that may have missed a step or two. The select list is the solution sets that are resonating the best. It's a marriage of quantitative and qualitative data points, and that's something that got launched earlier this year, which is a big undertaking by Chris and the team, and something that has resonated well with our advisors. And the entire team is very available to talk to the advisors that we work with if they have any questions around a particular solution set. So to your earlier comment, if whatever you invest in, know what you're investing in and why you're investing in it. And the institutional quality due diligence work that Chris and his team do, I think, is a big part of the value proposition that Orion brings to our advisor clients on the investment side of the firm, and it's a team that continues to take on additional responsibilities as the platform grows and continues to get additional resources. So I'm really lucky to work with Chris and his team. They're fantastic at what they do.
Quick question for you, Tim.
Yep.
In regards to the due diligence, I mean, that can mean a lot of things. I would assume you guys are looking at the myriad of like third-party asset managers, whether it be mutual funds, ETFs, maybe even some private funds. Like, are these advisor driven where they're coming to you and asking you guys to do the due diligence, or are you guys proactively going out, sourcing, finding, and then presenting this?
Yeah, it's a great question. It's a little bit of both. Paisley, my joke to Chris is, when Orion bought Brinker and Chris was asked to take on due diligence for this bigger platform, he's a great guy, but I don't think he ever realized how popular he was until he got that job. And then when I was asked to be CIO, I didn't realize how many people knew me in the industry. And it's like, can you take a look at this portfolio, this strategy? And I get it, right? I mean, folks are building portfolios, picking stocks and bonds. They believe in what they do. They want to get that solution set out to a broader universe. So, Chris gets pinged all the time by buy-side firms that would like he and his team to take a look at their offering. And there's some quantitative screens that help them decide whether or not, it's worth a second or closer look. We have a product committee where we'll take a look at what's being proposed either from the advisors we work with, because we want to be sensitive to that, or sales team members will come with suggestions that they're hearing from advisors. So some of it's coming in, and then some of it's sort of inside out, where we're looking at the platform and gaps or products or solutions that we don't have. And then Chris and his team are kicking off the search. So it's a little bit of both, probably a 50-50 dynamic most days.
Yeah, that like push pull. And then I would assume too, we have quite a few listeners, not only who are advisors, but also in the asset management space. Do you have any like rules of the road? Because I'm sure, like you said, you guys are getting pinged nonstop. Do you guys have like AUM thresholds, track records, performance thresholds where it's like, hey, if it hasn't met this, like, don't even bother. We got a lot going on here.
Yeah, we do. And at the risk of sort of misquoting the due diligence construct, we're looking for at least a 1-year track record, a Morningstar ID, and 100 million in AUM if memory serves. And then there, those factors and some other factors are part of the initial quantitative screen. And then that will give Chris and his team a decent idea as to whether or not they should peel the onion a little bit further.
Yeah. All right.
Yeah.
That's awesome. When I was there, I always loved working with Chris, and I know a lot of smart people on that side of the business.
Yeah, they're really good at what they do.
Those due diligence questionnaires, very comprehensive. I mean, you're talking like 100 to 200 questions. It's the due diligence that they do is really top notch.
And I would say too, just to make a quick point, like as an advisor, as an investor, that's some of the hardest work, is determining where to invest and how to access it. And so I think it already starts to bleed into the value proposition. Of course, you guys offer everything under your umbrella for an advisor to operate and run a successful business and grow their practice. But I think that's such an important piece, because if you think about, you're an advisor, are you spending your day doing due diligence, or are you actually servicing your clients, meeting with your clients? And I think that's why this outsourcing effort is so important for advisors that are lean and mean and looking to grow. They have that team that they can rely on. And to Josh's point, the extensiveness of this due diligence is can't be matched. So that's great.
Fair. No, I would agree 100%.
Tim, I would love to kind of pivot and talk about the kind of more the discretionary portfolio. So for those who aren't familiar with that term, maybe describe kind of what that means. And then one thing that I always loved, and we would always have conversations around this, is historically there's been a US tilt in a lot of those discretionary portfolios. And you always had such good talking points about why that was. Do you mind just walking us through some of those talking points?
Yeah, and I'll start there and then work backward. So, a former boss of mine, friend and boss, former boss, CIO, smart fellow. I remember talking to him about sort of Brinker Capital's bias towards U.S. equities, right? If you look at the ACWI, and I know it all moves around, but if it's a lot of folks, it's kind of a 60-40 jumping off point, 60 U.S., 40 the rest of the world. I know those numbers have moved given the incredible returns from U.S. equities. But Brinker always had a 70-30 bias, U.S. ex-U.S. And I just remember talking to this fellow. We were friends before we became colleagues, and I went to work on his team. And he said, listen, the way we think about it, and it really just made a ton of sense to me, is, well, one, our clients get paid in dollars, spend in dollars, invest in dollars, save in dollars, and are most attuned to the U.S. economy and U.S. markets, right? So this is just kind of what they know, where they live, what they eat and breathe. And then, so that's sort of the client sort of behavioral component of it is the way I would describe that. And then he said, you marry that with the fact that the U.S. is the world's largest economy, home to the largest, most liquid capital markets, and arguably still the world's most innovative economy given its size. You put those two things together, even with its size, you put those two things together. You don't always have to be 70-30 or 75-25. You can be 65-35, 60. You can go overweight, underweight, but it just made a ton of sense to him and the team that should be your jumping off point. That should be your neutral. And it made sense to me. I embraced that construct. Obviously, the U.S. Market up until this year has easily outdistanced the rest of the world. As you all know, you guys are investors for a very long time. So that's been an added benefit. But we're actually within our sort of construct, we're slightly overweight international equities and have been for a little while now. But that's how we arrived at, or someone else arrived at the 70-30 neutral construct, US ex-US. Made a ton of sense to me, and it's something Brinker and Orion has embraced on a go-forward basis. And then in terms of the discretionary portfolios, so Brinker Capital, again, one of the Orion acquisitions, best known for a suite of multi-asset class portfolio destinations. That offering still exists. It's been in place for over 30 years. So that's sort of a flagship proprietary offering. We're not picking individual stocks and bonds. We're finding what we think are best in class passive and active vehicles and blending them together. But that's a multi-billion-dollar franchise for us, and something that's created a lot of value for a lot of good people over a lot of years. And then we have a proprietary offering that really falls under Discipline Equity, which is a series of quantitatively constructed portfolios. That team's led by Frank Nickel. And then the fixed income offering, which came under the Orion umbrella when Orion bought Euro shop, Josh Townsworth Capital, now Orion CIO. That's led by Taylor Acevedo. Both those businesses are about $1.5 billion in AUM and experiencing really nice growth. So that's how the proprietary offering falls out. And with Discipline Equity and fixed income, we are picking individual securities, one on a quantitative basis, the other, as you know, Josh, on the fixed income and fundamentally driven credit and analysis and the like. But that's the proprietary solution set. And then on the platform, you'll find best in class firms like BlackRock and Vanguard, but also boutiques that Chris and his team have uncovered and feel comfortable adding. So it's really a broad solution set, very large, well-known household names, but also some emerging managers that we think can create real value as well.
So one thing I wanted to make a comment on was your point around the U.S. non-U.S. split within equities, Tim. And I heard something interesting a couple years ago that I think we've just continued to see take off, which is a lot of advisors who are U.S. centric here, that rather than benchmarking or using the global market cap weighted index like the ACWI as their kickoff point, is like looking at the collective, looking at the peer averages. And a lot of this can be found in, say, like Morningstar, and using that as like your starting place for building a portfolio, because ultimately everyone is so tethered to this very archaic global market cap weighted approach. And to your point, for all the reasons you've already mentioned, having this home bias, and many, advisors and investors across the world have some form of home bias, whether they're in Canada or Europe or Asia. And I think all of that makes sense. And so, like, why are we still using this old school way of thinking about, based on the market capitalization of the global investment landscape? That's not a very valid starting point. So it's just an interesting theme or trend that I've started to see a lot of advisors in the US start to look at their peers and use that average as like, okay, this is our home bias or our starting place for portfolio asset allocation.
Yeah. That's something that would make sense to us given our world view. And that is an interesting point. Paisley, as you look around the world, folks in different countries tend to have are predisposed to their own markets. They know them well. Obviously, they live in those countries. It's sort of like, you look at 401k plans, and a lot of workers have a fair amount of their 401k assets in their company stock because, they kind of get it and it makes sense to them. And, at the risk of, not sort of embracing the importance of producing, hopefully very compelling risk-adjusted returns. Sometimes for me, the idea of a benchmark isn't a good idea at all for the end client, right? It's sort of like, here's where I am personally, professionally, financially. Here's what my life looks like. Here's where I want to go. Here's what I'm hoping to do near term, medium term, long term, my legacy, whatever it may be. How do we solve for that? And I think, Chuck Widger, the founder of Brinker, was very thoughtful about that. It's about sort of your personal goals, not what the market is doing or not doing. And I know some people probably run that way because it's a way to get away from, well, how do you do relative to this or that? But I just think that's a better way to think about portfolio construction and investing.
So true.
Goal-oriented, outcome-oriented, and not so much S&P, ag, and some combination.
Yeah, because everybody has their unique, time horizon, risk tolerance, objectives, whether it be growth, income, preservation, diversification, whatever it may be. Yeah. And ultimately, as an advisor, then you're setting that expectation by having that benchmark. And so the client's going to say, well, S&P was up 25% this year. Why was my portfolio only up 12? And it's like, well, your objective wasn't to shoot for the moon this year. It was to have income and have a more balanced approach. So I think you're right. It's like shifting away from this kind of simplistic, like risk-based approach of like, where are you on the spectrum of like 30-70, 60-40, 80-20, wherever it may be, to what are your actual objectives? And it almost gets into this, which is starting to take off in the institutional space around this like total portfolio approach of like, let's, start to think beyond asset classes and like the 60-40 and like, what are your investments actually doing? Because there's so many innovative strategies in the marketplace now. It's sometimes hard to pinpoint them in a single asset class, and they do have dual objectives sometimes as well. So it's really modernizing like how we're building portfolios.
No, I think you're right. And I think, not to tell an advisor how to do his or her business. I work for advisors, so I've never been an advisor, but I think anyone listening that's just in that seat should heed your advice. And when you have conversations with clients, especially early on in the relationship, it's not about the S&P or the Russell or the NASDAQ. It's what's your money doing for you today? What do you want it to do? And I think you have that conversation from day one, and that's how you frame everything you're doing, because ultimately I think that approach leads to much better client outcomes, because it leads to better client behavior or more not thoughtful. I'm not trying to sound snarky, but just more sort of long term. You kind of frame the money in a healthier way. That leads, I think, to better conversations with the client, and then that drives better client outcomes. I think.
I know that I always bring this up, and I brought it up in my past roles, which is just kind of this idea of like through cycle returns. because there are periods of time where you're going to have very robust returns in certain asset classes, but then there's going to be periods of time that you're not getting the 20%, the 25% in the S&P 500, which is why I think framing it in that perspective of, well, through cycles, we're targeting this kind of return helps manage expectations. Because you're going to have these years like we've had this year and last year and the year before, but then you're also going to have years like 2022 where stocks and bonds both significantly underperformed long-term averages.
Yeah,
and so,
for sure.
Well, Tim, I want to discuss another thing that's near and dear to Orion's kind of asset management side of their business, which is custom indexing.
Yeah.
And, there's been this evolution in the industry that we've seen play out where you had mutual funds were the big dominant kind of vehicle for investing, and it made a ton of sense. It offered easy access, diversification, all of those benefits that would help retail investors invest. And then from there, it went to ETFs as being now like I would say the most dominant, the most tax efficient way relative to mutual funds. And so we've seen ETFs really dominate the asset management space as far as vehicles for investing. Now that you have this idea of kind of custom indexing, direct indexing that's become really popular over the last decade, do you mind just sharing with us kind of what is custom indexing? How does it work? What are the advantages of custom indexing versus maybe just going out and buying an ETF?
Yeah, no, and you're right. That's been the evolution. When I started working in the early 90s, I wasn't working in finance. I was working in New York City in politics. My brother was working in finance, really smart fella. And he suggested I start investing in a mutual fund or just start investing. I didn't have a ton of money. So I would put $25 a month into the Invesco Industrial Income Fund. And I would check the returns to the NAV every day in the New York Times. Anyway, I mean, back then, now it's all, anyway, it was all print. But I was like, what do you mean I'm down 50 cents or my $75, that I was so focused on. Yeah, right. Yeah, I know. Talking about emotional and I needed someone to help me just kind of pump the brakes a little bit. But yeah, I just remember that. So the way I think about custom indexing, some people call it direct indexing, is and we've got a wonderful franchise in that space here. Andy Rosenberger, who's a colleague and a friend from Brinker, he and his team oversee $11 billion in AUM now. It's become a very big business for us. It's a great solution set. So I'll describe it the way Andy describes it. Hopefully I'll get it right, because Andy's like a black belt in jiu-jitsu. If I get this wrong and he hears about it, I could be in trouble. You sort of take an index and you unpack it. So to your point, Josh, instead of buying an index fund or an ETF that replicates, say, the S&P 500, you just look at the S&P 500 and you buy either all 500 securities, give or take, in an SMA. So you own the individual securities, or maybe not all 500, but enough that replicates, broadly speaking, the performance of the S&P. And some of the benefits, right? The big one would be, in my opinion, the transparency, the look through, and the fact that you own the individual security. So if you then wanted to buy or sell just a security or two, as opposed to you would have to move out of the entire S&P 500 index or ETF. You can sort of nip and tuck based on maybe gains realized, or if you want to book losses, right? The tax loss harvesting dynamics of custom indexing are pretty darn powerful. Or, to lean on the word custom, if you wanted to sort of tweak the S&P exposure just a little bit because of certain values or particular interest in a part of the markets or the economy, lean more one way or another, you can you sort of customize the portfolio a bit. So I think that marriage of technology, sort of zero trading costs, you can do that at scale now. And Brinker was in that business, Brinker Capital, my old firm, years ago, and not to throw Brinker under the bus, but it was a pretty small offering, and we also had to outsource the sort of portfolio optimization work. The people that were helping build each of the very specific custom index solutions for our clients, because we didn't have the technology in-house to do that. And being part of Orion had that portfolio optimization software, and it's one of the reasons why Andy and his team have gone from a small amount of AUM, call it 4 or 5 years ago, to 11 billion. So it's been really powerful. And the way I think about it too is, if you're, and again, you folks know the markets as well as anyone. If you're buying a stock or a bond, the way I think about it is, I mean, you're obviously hoping for some sort of financial return, but you're loaning money to a company, right? And so again, back to sort of the values-based approach, or where do you want your money to go, and what do you want your capital to do? And I think again, sort of custom indexing allows for customization that transcends, and I'm not knocking sort of thematic portfolios, ESG portfolios. Those are all very powerful vehicles for some people, but imagine being able to do that at a level of personalization that was kind of unthinkable 5 or 10 years ago. So it's just, it's sort of customization at scale, which is an oxymoron, but it's really cool, I think.
Yeah, no, I worked at Invesco for about 7 years prior, and we had a large indexing business. And I think you're correct, Tim, in thinking about this. Like the theme around customization was historically only available to large institutional investors.
Yeah.
And then we had this like wave of excitement around ESG and SRI. And what we found when I was at Invesco was, at the end of the day, a lot of clients ultimately wanted the framework around these, like, non-tilted away from market cap, which is also the factor space.
Mm-hmm.
But a lot of these like ESG or socially responsible investing just came down to customization. And I know broadly the direct indexing is way greater than the ESG efforts, but I just think about it from the 30,000 foot view of the tools that advisors have today that they did not have 5 years ago, 10 years ago, that allows them to deliver what historically was this institutional caliber customization through like SMA or these direct indexing portfolios. I think just is such a value proposition for these advisors when working with clients, whether it be, tax loss harvesting, or whether it be concentrated equity positions, or thinking about ways to really deliver a unique investment objective for clients that have really important values or parts of the market that they want to access. And this kind of goes back to, why advisors would want to work with, platform and of service like Orion, beyond all the other things that you guys offer, is the access to this under that same umbrella, kind of that turnkey approach. And I do think that's really the way of the future.
I would agree. And to your point around sort of concentrated positions, or, positions that have done well, right? We've been fortunate to look through a remarkable 15 years for U.S. equities, even with 2022. And one of the benefits of custom indexing is you can sort of take, help an advisor take a client that's got, a couple companies that they've invested in that have done really well, and you can build a custom portfolio around those concentrated positions that have meaningful embedded capital gains, and kind of manage out of those positions over time, set a capital gains budget, do it in a way that is driven by the client, as opposed to sort of driven by the marketer ripping the Band-Aid all at once, which can cause all sorts of problems from a tax point of view. So and that's not all that custom indexing does, obviously, here or with other firms, but that's been a big part of, I think, why it's done so well.
Yep.
I think one thing that's really cool when you look back is just the impact on technology, and how technology is really the driving force that has allowed all of this innovation and all of these things to come to everybody, right? Like, to Paisley's point, like, these are all things that, yes, you could get access to if you were a large institution and you had a ton of assets. But how cool is it that now everybody can get access to this with relatively low minimums into these types of strategies? So it's just, once again, like the power of technology and how it's impacting all of our lives without us really realizing it at the end of the day.
Yeah, for sure.
Tim, and you and I have had a ton of conversations around the economy and more of these kind of economic things. And actually, one of my favorite things that I learned from you was this idea that, you obviously have the economy, but you have the stock market, and sometimes there can be disconnects between those two, right? Where, just because maybe we think things aren't going as well in the economy doesn't mean that you still can't have really good performance in the stock market. I know there's a lot of people nervous about the economy. What are you telling people right now from what you're seeing, as far as, like, I mean, do you think is the world close to going to end? Is the United States going to get taken over by China? I mean, I hear these narratives all the time, and I'm just kind of, what are you seeing? What are you telling people?
Yeah, no, as you know, I'm an optimist at heart, though I like to joke, it's not easy coming from New Jersey and being an optimist. With all due, I'm not trying to cause any trouble for my friends from New
If
Jersey.
anybody that's listening is from New Jersey, we apologize. It's an
Yeah, I apologize. And I think I'm allowed to say it. It's like Will Ferrell and Talladega Nights. With all due respect, just because you say with all due respect doesn't mean you yes it does. So and you're right, and you guys have been in the markets for a long time. And I also, this may sound snooty or maybe not. So I came to our industry later, like late 20s, early 30s. So I worked for people in our industry, which is what got me interested in our industry, which is another way of saying I grew up not studying finance, not studying economics, in the spirit of full disclosure, and from a family that had very little interest and didn't traffic in this world. So I remember being very personally susceptible to these headlines. Like I remember 1987, the Dow's off 20, sort of the S&P Dow crashed 20-25% in a day. You end up but I was like, oh my God, the world is coming to an end. Or the early 90s, a reunified Germany and ascended Japan were going to eat the U.S.'s lunch. Or markets would never recover from the tech media telecom bubble of the late 90s or 08. And I mean, I was already working, but so I didn't know much. And so I would, and then you look back, you're like, wow. And I'm not trying to be flip because a lot of people got hurt during those different downturns, but you're like, no, the economy is still here and the country's still here. So after a lot of sort of reading of economic history and talking to some really smart people, like my construct is basically, as you guys know as well as anyone, at least over the last 50 years, the U.S. economy's been in recession about 10% of the time, and markets have fallen about 20% of the time on an annual basis, something like that, right? So I'm just going to put history on my side and assume, not willy-nilly or in a Panglossian way, but I'm just going to assume the economy is going to be okay. The markets, that's like my default until something tells me it shouldn't. So as personally as I look around today, I don't think anything to me personally screams buy this, buy that. Like something's really on sale, like it's April of this year or late 2022, when sentiment was on the floor and bond yields, did what they did or so on. But to me, I don't think we're in a bubble. I think the economy is in pretty good shape. I know, and you guys, again, know markets as well as anyone, stocks aren't inexpensive. They're a little cheap, but balance sheets are pretty good. The bond market's not screaming, that something's wrong. And you have these policy levers like the One Big Beautiful Bill Act, which should stimulate spending, as you know, and the AI build out is real. Now, some of that money or all that money may end up being wasted, but do you find that out tomorrow? Do you find that out in 12 or 24 months? And the Fed's cutting rate. So I know sometimes it's kind of boring to just kind of be like, yeah, I think things are pretty good, and I'd probably say invested right now and broadly diversified. And some pockets look a little bit better, like ex-US and small cap. But I think a lot of the times in this business, it can get a little hard because it's kind of like, yeah, things are pretty good. The house isn't on fire, and at the same time, everything's not a screaming buy, and that's kind of where we are. I have a hard time betting against the U.S. economy right now. I really, really do, and I think risk assets are going to be okay into 2026. Unless we do something with China, or God forbid Russia does something in Eastern Europe, I think we would have to do something around trade that goes beyond what we saw in April, which I don't think that's going to happen, or God forbid, Vladimir Putin seriously does something in Eastern Europe that is existential in nature. And between now and call it 6 months, I just don't know what else would do it. So I don't know. What do you guys think?
Yeah, I would echo a lot of that. I think like history is on our side. If you look at the statistics and the data, markets tend to go up more than they go down. And so to come out of the gate already betting for, a massive recession or the impact like we saw in the GFC or the Great Depression, like what captures headlines and gets pushed out in the media is these polarizing views up or down. And to your point, Tim, majority of the time we're hanging out in the middle, which is this boring land. And people don't like to talk about that because that's not fun and exciting. And it's such an emotional business in the sense that people's relationship with money and their wealth long term is driven by emotions. And so people want to
Yeah.
feel that. But ultimately, and a lot of people might disagree with this, but when things are boring, that's usually a good sign. And to your point, I would concur that there's no screaming opportunity right now from a valuation perspective, from a sentiment perspective, which just leads us back to having a long-term strategic diversified portfolio. And again, maybe that's not as fun and exciting and let's all pile into gold. But Josh and I actually recorded what we call a quick take, which is a shorter episode with just Josh and I for this podcast that we're going to publish here soon, that talks about diversification. And ultimately, it's, as Josh says, it's about the journey. How do you get there and how do you stay on track? And ultimately, I think there's plenty of signs as to why markets can continue to go higher. And it's usually the unforeseen risks that throw markets off track, right? It's not the things that we already know of or that we're aware of. So buckle up, diversify, and stocks for the long run.
Yeah, no, I think that's all well said. I remember reading an interview with Robert Rubin, who was Bill Clinton's Treasury Secretary after Lloyd Bentsen moved out of that role, and he was co-managing partner at Goldman Sachs, and sort of a titan of Wall Street in the 70s and 80s and into the 90s, maybe even the 60s. And I remember reading an interview when I was new to all this, and I was just trying to figure out stocks and bonds and all that work. And I think he ran the prop desk at Goldman when running the prop desk at Goldman was like a big deal, right? Because they kind of got handcuffs put on all the big banks after 2008 and 2009 in terms of capital, and it just stuck with me. And he said the hardest thing about running that desk and all those traders was convincing people that most of the time the best thing to do was nothing. Like these windows open up and then you move and we're prone to action. We want to, and that just always stuck with me. He's like, that was the hardest thing. That was the hardest part of my job, convincing this army of traders that a lot of times, you don't do anything until you know it's time to do something. And that just really made an impression on me.
I love that.
Tim, that's unbelievably great advice. And I think there are a lot of advisors that will be listening to this because this is the #1 podcast on investing. But if there's anything that they could take away from this podcast, I think you just hit it on the head, because there is a tendency for financial advisors to feel like they're not adding value because they're not tweaking the portfolio every single day. They're not doing this, they're not doing that. When in reality, you add the most value during times of distress. And you add, and that is when you add the most value, and that's why you get paid what you get paid. And
well said. No, I think that's spot on. Yeah, no, I appreciate it. Well, our thanks to Bob. I'm calling him Bob like I'm friends with him. Our thanks to Mr. Rubin, wherever. That'd be pretty neat. I'm not trying to be, I think he's still, I'm sure he's older, but maybe you could get Robert Rubin if he's still with us, and I hope to God he is. That'd be pretty cool, because he could be episode. I don't know how you top Tim Holland, but maybe the former managing partner of Goldman and Treasury Secretary would do it. Yeah, probably.
We'll work
he's
on
probably
that.
listening. He's probably listening just because this is the #1 podcast on investing. So if you're listening, please reach out to us.
Please call it right now.
That would be so great. That would be so great if he heard about this and you got him on.
Oh my God. We're manifesting. We're manifesting this. I will reach out to him, or Paisley will try to reach out to him. We'll make this happen.
Wonderful.
Well, Tim, we want to end with one quick question, which is, is there somebody out there who had a big impact on you and your career? We'd love to just hear who that is and a little bit of that story.
Yeah, I had a former boss, long-only investment firm, when I used to help pick stocks and help manage some 40 Act funds. We became business partners eventually. His name's Philip Tacho. And I was with him in 2008 and 2009 when everything was going to heck in a handbasket. And he did a couple things for me. One, he told me, and he had been in the business for a while, he's older than me, the importance of pattern recognition. He talked about how, the movies, he's like, I've seen this movie before, and his ability to help us navigate 2008 and 2009 and what he thought the Fed would do, and when it got really unpleasant, what he thought the government would do. Until this whole thing falls apart, and I don't think it's going to fall apart in my lifetime, there is that sort of cyclicality to it, the markets, the economy, the policy response. So that was really big for me. And then he also talked about just the importance of trying to stay calm and stay grounded and keep things in perspective, especially when you're going through those difficult periods, because if you can't do that, you're going to make poor decisions, and those poor decisions are going to rebound onto your clients and your clients' clients, and that really struck a chord. And one of the things he had me do was take the Dale Carnegie course, which I took in '08 when everything, and kind of being snarky, I guess, in my response was, I was already doing a fair amount of public speaking and presentation work, and I said, I think I'm okay with that. And he said, he's like, the course is only nominally about that. It's really about how you make decisions, how you deal with stress and pressure and compartmentalization. He's like, I really think you would benefit from that. And he was right. I really, really did. So great stock picker, great person, great mentor, and sort of how he helped me and us through that really tricky GFC period, really, really benefiting our clients. And I learned a ton from him during that period in particular.
That's awesome. Well, thank you, Tim, for sharing that.
Yeah.
With that, we'll wrap it up. Episode 8, we crossed the Rubicon, or we've gotten through episode 7, and now we're on to episode 8. So this is fantastic. So Tim,
this is the J curve. This is
the
now
J,
parabolic from here.
All payoff.
Yeah, most popular podcast.
Number
one podcast.
Yeah, number
one.
Sorry.
No, Tim, thank you so much. And, as a personal friend of mine, a mentor of mine, thank you for joining us. And it's been a pleasure.
Yeah, no, thank you both. Congrats on the podcast. And I look forward to listening to the episode, watching the episode with former Treasury Secretary Bob Rubin. That's going to be awesome.
2026 goals.
Yes.
Awesome. Thank you. Thanks, everybody.
The views and opinions expressed on this podcast are those of the host and do not reflect the views, opinions, or policies of any current or former employer, affiliated firm, or client. The content is provided for informational and entertainment purposes only and should not be considered investment, legal, or tax advice. Nothing discussed constitutes a recommendation to buy or sell any securities or investment products. Listeners should conduct their own research or consult with a qualified professional before making any financial decisions. The hosts are speaking solely in their personal capacities, and the podcast is not affiliated with, sponsored by, or endorsed by any firm or organization with which they may be associated.